Let's now turn to what we're seeing in the SMSF space. Regulators are stepping up scrutiny across investment chains as concerns grow around investor behaviour and risk taking. Liam Shorte is joining us from SONAS Wealth. Liam, welcome back to you. So, are we seeing a return to GFC style risk appetite, do you think?
Yes, definitely. The changes in the CGT rules, the Division 296 coming in, there's a whole focus now is changing. But what really worries me is I get that feeling that we're back to that 2008 level where people were just ignoring the warnings that were out there. The danger in the Middle East is definitely locked on. In fact, it's now more serious than it's ever been. And I think people just have, again, it's because of this 24-hour news cycle. People get bored with the news and they just think, oh, we can ignore it, still take risk. They're all chasing, investments in data centers and AI and everything like that. I just think now's the time to actually be putting money aside into a cash reserve or an opportunity fund, because we're 16 years after the GFC. There's a lot happening around the world. And I just think the best thing you could be doing is building a war chest, because there will be some good opportunities over the next couple of years to buy stocks at significantly cheaper prices.
So when you talk about an opportunity fund, how is that structured? That's simply taking cash and putting it in some deposit?
Yeah, look, you can get high interest cash accounts now paying 5 to 5.25%. That's a nice safe earnings while you sit some money on the sideline. But also taking some profits on stocks that have done well, or stocks that may now be under pressure because of the changes the government have made to negative gearing and to capital gains. A lot of our big banks, they are purely home lenders, and some of the big institutional managers see that their future profits are under threat. So they're short selling some of the big banks. So it may be time to take a bit of your profits on them, set the money aside, because there will always be opportunities. Opportunities will come up.
Now, Lee, we continue to hear news stories about investors losing their life savings, their super investments to dodgy schemes. What is ASIC doing at the moment, particularly on lead generators and spruikers?
Yeah, so they're naming the firms that have used these lead generators, really to just put people on notice. They're clamping down on the finfluencers as well. More so, they're now moving to say to all market participants that they need to be doing their own due diligence and not relying on or passing the buck to other parts of the industry. So providers who design these products, promoters who are out there advertising them, the research houses that are being paid to provide research papers on them, the platforms that allow them to be listed on their platforms, and the actual planners then who advise on them. No longer can one of those just say, oh, well, we got the research and the research said it was good, or it's on the platform and the platform wouldn't have put it on there if it wasn't a good product. Now each one of them is going to be expected to really do their own due diligence and not just pass the buck when something goes wrong.
Now, Liam, given the policy changes we've seen, obviously Div 296 in terms of tax treatment in super funds, but at the same time, more recently, obviously the changes to capital gains tax affecting all asset classes. What are we seeing in terms of investor demand at the moment? Perhaps moving towards income rather than that capital growth?
Yeah, and we're seeing this across all sectors. So, for example, a lot of people would have international stocks previously looking for the growth because that's where it was coming from. But now we're seeing, good companies with reputations like Vanguard who are coming out with like their Vanguard International High Yield Fund. So matching what investors in Australia love on dividends, here, they're now starting to offer those products overseas because there's more of a focus because of the capital gains tax changes on getting that income. So we're seeing a renewed interest in equity for income, unlisted property trusts, and annuities coming back in. I got an annuity, a 5-year annuity this week for 5.75%. So that's locking away 5 years of a client's future pension payments at a guaranteed 5.75% return. That means I can leave the rest of their portfolio taking a bit more risk in good long-term stocks. and property investments without having to worry where the pensions are going to come from. And I think your last guest was saying, a lot of investors, that they're property investors, they're now changing their focus a little bit, and they're going, well, maybe I need to look for a property that's delivering a higher rent rather than one with growth potential, because I'd rather get the steady income than having to pay a high capital gains tax later on.
Yeah, in fact, we've seen that anecdotally, at least, with investors moving from residential property to commercial to seek that yield. Leah, let's go to our question of the week. This one being saying, I've signed a contract in Tasmania in my personal name and now need to nominate an entity as the purchaser. The sticking point, they say, is the lender wants the nominated entity's name to appear in the contract itself. My lawyer, though, saying on the other hand, says a deeded nomination on its own is enough and the contract doesn't need to be amended. What do you make of that?
Yeah, so this is an ability in some states when you're doing a property contract to write it in your own name as nominee for if your entity isn't ready. This is really dangerous with SMSFs. So, in this case, even though legally, yes, you can do it, a lot of lenders are not going to be happy about it. In most cases, in this circumstance like this, I would tell them to go back to their lawyer, to go to the vendor and ask to rescind the current contract, change the contract into the name of the SMSF bearer trustee or the SMSF trustee if they're buying it outright, and not trying to mess around with the existing contract, because it could end up with you paying double stamp duty. And even though you may be doing everything correct according to the SMSF rules and the property rules, stamp duty is a state tax, and the state governments do not like giving exemptions. So if there's an opportunity for them to get you on stamp duty, they will take it. So it's another case of just because you can do something doesn't mean you should do it. And best practice is always to have the contract in the name of the SMSF trustee or bearer trustee, depending on whether you're borrowing or not.
Now, Lee, just finally, we were talking obviously the attraction of yield at the moment. Interestingly, you brought to our attention marketers offering Turkish properties. This is the locations around the 2030 FIFA World Cup, promising 15% per annum overall returns. This sounds very attractive, but is it a case of too good to be true?
Yeah, and look, this is probably, with ASIC clamping down on influencers and lead producers here in Australia, what we now need to realise is we're in a global world, so it doesn't. These offers are coming out of Dubai, straight into people's LinkedIn, straight into their Facebook feeds, and they're because it's so attractive. You only need 75,000 to buy into one of these units. It's offering 8% rental yield, 15% overall value, but in most cases, these are areas that have been totally underdeveloped for years. Yes, they'll take a sugar hit from the FIFA World Cup, but you've got no understanding of what's going to happen after that. And we've seen it with a lot of Olympic games and FIFA, that there's often a lot of white elephant areas after the games are finished. So, I see even these people from Dubai, they're saying you don't even have to have the 75,000. You can start with as little as $150. When you hear things like that, that should be red light warnings that these people want to get anything out of you. Even if they can get a couple of thousand out of you, your money could be gone. So my philosophy is something like that. If you don't understand it, if you don't have local knowledge, then you're better off buying a lottery ticket.